Is it possible to create risk-free trades? Hi, I'm Jan Motat, the Chief Market Analyst for TIO Markets, and I'm here to study the markets with you. We're going to find out if it's possible to create trades that are risk-free. So hopefully this is interesting, and if you have any questions, I'm very happy to answer those. And afterwards, if you're watching this on video, please send us any questions you might have at on TIO Markets at support at tiomarkets.com. So basically, without the risk, there is no return, and the markets wouldn't function. They wouldn't exist without risk. So there'll be always some risk related to trading, but now we're studying if we can create risk-free trades to the extent that it's possible. There are always some risks that remain, and then in this webinar, I'm going to teach you to understand and identify those risks and maybe even control them as well. So let's see what we can do about this. So the idea is that we like to create trades where we can stop stressing about them, we can eliminate the risk to the maximum degree it's possible, and then we can let the market work while we can concentrate on something else. So by the definition, you might guess that we're not talking about very quick scalping. We are talking about intraday trades and swing trades, or maybe even position trades if you like to basically use the same principles there. Please remember that none of this is investment advice. You should read through this and remember that this is only for educational and marketing purposes. Thank you. Okay, here's my background very briefly. I don't really want to spend too much time on this. You have seen, some of you, this already. But over the 20 years, I have learned quite a bit, and I really want to share from this knowledge base and help you guys to grow in your own trading quicker. And you can read my daily analysis at tiomarkets.com/analysis. You can register there for free, and then you get the analysis emailed to you on a daily basis. So in this webinar, we will cover what every trade entry strategy should include, and also 2 methods for making trades risk-free as much as it is possible. And then I will teach you also how to set targets. I'm kind of rushing through here because I don't want to spend too much of your time with these. I want to get into the meat of the whole thing. I want to talk about the strategies themselves, which I'm sure you are here for also. But again, if there's anything that you feel like you would like to understand better, you would like me to explain again, please tell me, and we can take a look at your questions and cover some stuff again if possible. So every trade entry strategy should include at least these factors. You need a momentum analysis. Basically, you need to be able to understand the market direction. Then you need to understand where the key support levels and resistances are and how to factor them into your trading plan. And we can talk about this later as well. If I forget, let me just remind me and we get back to it. And then price action based trade entry signal. This is something that some people seem to be missing based on the questions I get. It's basically this is my approach. This is how I see and view the markets. And I've seen over the years that some big names in the industry of trading and fund management, they actually agree with the same ideas. They basically follow the same principles themselves. So once you understand the momentum and you understand where the key support and resistance levels are, then you look for price action based trade entry signal. I mean, you can go and trade with random entries, but I don't think that's really what you want to do. There's a better way of doing things. We can understand what the price tells us, and that is the key. Then obviously we need a risk management plan, because trading should be your business. It's not a hobby. It's not a gambling game. It's not something that you approach with lots of emotion either. It's something that is a business. If you have a business that makes money, then the purpose of the business, That's what sorry, that's what the purpose of the business is, and this is what we are aiming for. And I want to go through an example here. This is a very recent trade idea I posted in the TO Markets Telegram channel, and I was saying at the time that I was looking for short trade signals in Dow Jones below 32,766, and there my targets were T1 target 1 at 32,670 and the target 2 at 32,590. Then, because we don't provide any investment advice, and also because you as a trader should always think in terms of scenarios. What if this scenario doesn't work? What if my price action or the price action in the market doesn't kind of support my idea? Then where might the market then move to? And then if you do this thinking work beforehand, then you have a better idea on how to react to the price once it starts moving. And it also helps you not to get married into one single view of the market. A lot of people, they have an opinion, and because they are opinionated people in their lives in generally, they want to force the market to do what they believe that should happen. And the market really doesn't care. The market doesn't know you exist. The market doesn't know you where you bought or sold. The market really does not care because it doesn't know. So, therefore, it's just a newbie mistake to go and try to force the market to do something. And what I mean by forcing the market to do something, it's something like this. The market moved down here, and then it moves higher. People start shorting the market. Then the market moves higher again, and they short again. Then the market moves yet again higher, and they keep on shorting, and that's how they lose money. That's how the accounts get destroyed. So instead of that, I want to give you a better idea. So with this trade idea, we have the point one covered. We have the momentum analysis. So first of all, the market was rallying higher. Yes, true. But then it started to lose momentum. Somewhere up here, sellers came in, and when the market tried to rally again, the sellers appeared once again. So basically you have either a double top or maybe even a lower high, slightly lower high. And then you have the neckline of this formation broken here. So that was my sort of threshold level of 32,766. These things put together prompted me to think that, okay, the market is likely to move lower. So let's have two targets, one at 32,670 and then one at a lower level. And by having two targets, you actually increase your chances of success because you're not married to one single idea. The market could move to target 1, but it also could move to target 2. So at least if you cover some of your profits there, then you're in a better position if the market doesn't go to target 2. Anyway, let's move on. So then you need the price action based trade entry signal. The point number 2. The key support and resistance levels we should cover. And I also already pointed out to this level and said that this was the key level for me. So this really was my focus here. The market made lower highs or double top and then broke this support. So I was focusing on this key level, and if the price stays below it, I look for shorts. If the price rallies above it, I look for longs. And therefore, this was the key level mapped here. If you read my daily analysis, I give you some other levels also, usually more than one. Maybe there's 3-4 levels. And they are levels where the market might move to within, say, 1 or 2 days, depending on the volatility. And today we should get a lot of volatility because we have the US CPI numbers coming out and everybody's looking at what the Fed might do now. Is the Fed going to stay as hawkish as it has said it would? And if we get the strong CPI number that is higher than the expectations, then the dollar should rally, and that would be bad for stocks, commodities, commodity markets, commodity currencies. So keep an eye on what's going to happen today at, I think it's 1:30 BST, British Standard Time. British summertime. Then the price action based trade entry signal. This is what we're going to look at in a moment. And risk management plan. You need to have a plan for how much you're going to risk. If the market's going to move against you, and it often will, then you have to have a limit to your losses. Otherwise, you won't be trading tomorrow. The whole idea of this business is you're going to be there not only today, but also tomorrow and the next week and the week after, the next month, the next year. You have all the power in your hands to limit your risks, but some people choose not to. I've seen people blowing $1 million accounts because they just believe that the market eventually turns back and doesn't, and therefore there is no need for risk management. So decide how much risk per trade, how much risk per day, how much risk per week, and that will keep you in check. Okay, now the point number 3. Price action based trade entry signal. While this chart here was a 2-hour chart, I'm looking now at a 10-minute chart. And the market moved down here. This was roughly at the time of the publication of my trade idea. And then down, but not quite to the target, and started to rally. On this white candle, I was thinking, okay, maybe the market now rallies back above the level and goes to my alternative scenario target, which was 32,850. But then watching the market for a little while, it started to make lower highs. Can you see in this 10-minute chart how you have this high is lower than the previous one, the next one is lower, and the next one is lower. So that's where I started thinking that, okay, that the bulls aren't really that strong. The bears are pushing the market lower. And then the market hit my target, 32,670. This was the target 1. But if you didn't go short there was another opportunity. The market rallied back to my threshold level, to 32. How much was it? Let's go back. The 32,766 was exactly the high of these candles. That's where the sellers came in. And then quite often the market tried to move higher, but couldn't. There was resistance, and the market moved not only once or twice, but 3 times. It moved into this 32,670 level and then started to rally and moved higher. Now, here's an example of price action based trade entry signals being applied in a 10-minute chart. You can look at different time frames and find different signals and test them with historical price data. But here's one example how to do that. And once you have something like this in place, once you have identified lower time frame in a lower time frame chart some weaknesses in the price action, like the market not being able to penetrate the threshold level anymore, or the neckline level if we look at the 2-hour formation, like this one here, then you have a price-based signal for your trade entry. So it's basically giving you an opportunity to say, okay, I'm going to sell somewhere here close to the resistance level. I'm going to aim for this target here, and I'm going to have my stop somewhere above here. Placing stops is a really difficult game. There's no perfect way of setting stops, but the main rule is don't use the stops that are too tight, because if the market fluctuates a little bit more against you, then it might often happen that the market moves to your stop, triggers it, and then it's quite happily moving in the direction that you anticipated in the first place. And that is really annoying. I mean, that is one of the most annoying things that can happen to you as a trader. You had everything right, you did all the analysis correctly, but then the market moved to your stop and then to your target. So you lost some pips, and the market just moved exactly like you expected it would be moving. So some people use ATR, average true range oscillator, as a guide. So if the market is finding resistance there, add 1 or 2 ATRs on it and have your stop there. But remember, the further away the stop is from your entry price, the smaller your position should be. Don't be sort of a fixed mind trader who always trades 1 lot or 5 lots or 10 lots or whatever. Be flexible and think, what if you need to be rigid in something, that's definitely your risk management. So if the stop is further away from your entry, then the position is smaller. So if your stop is here, your position is a little bit bigger than if your stop is up there. Like I said, there's no right answer to where to place the stops. It really depends on price action. It really depends on your views on the market. Then, any questions this far? I know if you are a very experienced trader, this might be very simple ABC stuff for you, but if you are not, if you haven't been trading for a long time, then you might want to actually ask some questions. So please type your questions in to the chat box and I come back to them in a moment. But meanwhile, while the others are typing, I'm going to go into these methods of making trades free of risk as much as it is possible. Here's the method 1 and the trade execution sequence for trades with break-even stops. So first of all, you execute an order after a trade entry signal, and you remember from the previous example that the trade entry signal is something that is price action based. The price tells you it's not going to be able to move higher, so you're looking for short opportunities. If the price tells you it can't be moving lower, then you look for buy opportunities. Okay, Jennifer is asking 0.10 lot size. How much should be the capital? So if I get your question right, you're asking how much you should have on your trading account to basically be able to trade 0.10 lots. It depends on the trading style. It depends on your how sort of big time frames you're looking to trade. But if you are a trader with a small account, and if you're very new to the market, then practicing with 0.10 lots is pretty good. It keeps your losses small. And basically, what should be the capital to start with? I would not really tie that to 0.10 lots. I would say have at least maybe $200 on your account, and then that gives you some breathing space. Say because there's sometimes you have series of winning trades, but sometimes you have series of losing trades. And it's nice to have this cushion on your account that you don't start feeling like, okay, oh my, I've lost now 50% of my account, because that will impact you mentally. But if you have $200, for instance, on your account, and you're risking, say, $10 to $20 per trade, then you have quite a number of trades to take before you even come to a risk of losing 50% of your account. So hopefully this helps you with the answer. Aline wants to know about Bitcoin and also about pound. Let's see if we have time to look at the markets later on today. But let's cover the stuff that I say that I would be covering today. Lati is saying if the target for the trade is if the target for the trade to go down, but then it keeps on going up, what should we do? Okay, that's if you're basically asking what should you do if you believe, let's say that you have a trade idea that the market is going lower, but then it keeps on going higher. And you've sold at level X, market moves down first, makes you some profit, but then the profits are wiped away, the market comes back to your break-even level. Okay, this webinar is actually answering this question if we go just a few more slides ahead. So I hold this question a little. Aline was answering Jennifer. Okay, fine, excellent. Thank you. You guys are being active. I love this. I love your questions and comments. Keep them coming. This is good. Excellent. So, trade execution sequence for trades with break-even stops. So you execute the order after the trade entry signal, you place the stop order, and you place your limit orders to take profits, and then you wait for the market to move towards your profit target, and that's where you bring the stop to the trade entry price. Again, if you're an experienced trader, you might have been applying this strategy already, and you might have an opinion on it, but if you're a new trader, this is something that you might want to now look into as I give you an example of what I'm meaning here. So here's the trade execution sequence with a chart. This is a US oil chart, a fairly recent price action here from the August 2nd. And the market had rallied to resistance. And this, by the way, is a 30-minute chart. So then we get a price-based entry signal when we have a rejection candle at resistance and we have the price moving below the rejection candle. The candle low is 95.03. So let's say that the trade entry short takes place at $95. And for the simplicity's sake, we have the stop loss order at $1 higher at $96. And then we have to place the limit order somewhere. And I have used the recent lows here because when your market is ranging, it often moves back to the recent lows. And obviously the other option would be to have it somewhere closer, but I wanted to have sort of reward to risk ratio of 3. So we're risking $1 in the underlying, i.e. US oil, and then we're looking to make $3 in the underlying per contract. And per contract I mean whether it's 0.1 lots, 0.5 lots, 2 lots, 5 lots, whatever. So basically we have the trade entry short at 95 and we have placed the stop order, we have placed the limit, and now is the time to wait for the market to move towards the profit target. So the market has moved lower, it's trading somewhere down here, and we could say that there is also a technical reason to consider in a situation like this. There's also a technical reason to consider bringing the stop down to the entry level. And that's this here. This area was a resistance, so you never know if the market just bounces higher from it. So what you do, you move your stop from 96 to 95, and now you basically have a risk-free trade as much as a trade can be risk-free. You have to pay swaps, you have to pay spreads, there could be a market gap, especially over the weekend, etc. But as far as eliminating the initial market risk between the entry price and the stop price, this is how you can do it. Then what happened afterwards? Market moved down, down, down. We have the stop at 95, and then the market doesn't move to the 92 level. It starts to rally higher. So with this strategy, with this method 1, you really don't have to do anything. And this is an answer to Latte. Latte was asking, what do you do if the market goes down but then starts to rally higher? If you are clever with your stops and bring them down to entry level, once you have, reasonable size of profits here, it's something I can't give you an exact percentage or ATR value or underlying dollar values. Because I guess something like that doesn't exist. You can't make a hard and fast rule about it, but my rule is that once there is so much profit that it would be really a shame to lose all that and then also to risk the trade to become a loser again. Because obviously every trade is a loser at the moment you initiate it. You pay the spread, so you are in a loss already. You have the trading fees in the form of spread quite often. So you are making a loss. Plus you are exposing yourself to possibility of loss as well. So really don't want to, when the market is down here, I really don't want to see the market rallying higher again and then moving even higher. Okay, in this situation, the stop is moved down to 95, so there is no risk. And the market moves to the level, stops the trade out, and that's it. Sorry about this. I need to silence my phone. Okay, here we go. So the market stops the trade out and then rolls over. So this example is so great because it, on one hand, it demonstrates the sort of benefits of this strategy, but also the weaknesses of this strategy. So the benefits are that really during this time, you don't have to worry about the trade, because there's no initial risk anymore. The initial risk has been taken away by moving the stop to the entry level. And then, okay, that's the benefit. But then the sort of the downside to this strategy or the method is that if the market does this, it moves up there, doesn't move to your initial stop and then rolls over, you kind of lost the opportunity. But in this example, at least, there was another opportunity to go short at even a higher level. So you have the momentum loss candle there, and when the price moves below it, you can go short if you like this idea. So there's lots of variations of this, what you could do, but I just want to stick to a very basic picture here so that you have time to absorb the idea, and then you can go on your own and develop it further. Does it make sense to you guys? Any comments on this particular method? Do you like break-even stops? Have you been using them? Do you really think they are just awful? They just stop you out too often and then the market moves in your direction? Let me know what you think about this risk reduction method. I mean, if you are a trader who has time to initiate the trade, but then you have to go and work in your daily job and you can't monitor the market anymore, then a strategy like this can be so much better than allowing the market to move against you and basically hit your stops, or maybe even go further if you don't use stops. I strongly advise you never trade without stops. That is just a fool's game. That's a way to lose a lot of money. Every business needs a way of managing risks. Okay, Alin is saying, love break-even stops mostly when the market gives mixed signals or news are coming up. Yeah, that makes a lot of sense. Very good, Alan. Very good point. If you have a news event coming up or risk event coming up that is likely to cause additional volatility and you already have a trade in place, it's good to bring your stop to break even. Yeah, good. Okay. I love that, Alan. Thank you. Thanks for the participation. This is good. Hey, all right, let's move on. The method number 2. Here we have a slightly different trade execution sequence, and I call this a 2-unit trade. Here we have 1 unit equaling 0.5 times the total risk that we're looking to take. So first of all, divide your maximum risk per trade into 2 trades or units. 1 unit risks $50 and the other the same, instead of you risking $100 on 1 unit. And very soon I'll give you an example and explain why this is such a good method. This is actually, in my opinion, better than just break-even stops. Now then, point number 2. After a trade entry signal, you enter 2 trades and you place a stop loss order at the same level for both trades. Then you go and place 2 limit orders at different levels to take profits. Let's go and see how this works. Okay, here we are using the same example again to keep things very simple. And then you can guys, take a look at the markets and see how you can apply the same methods on your own in different market situations. So here we have 2 short entries at 95 and we place 2 stop orders at 96. And then what is the risk here? It is $1 per 2 units, or $1 of underlying from 95 to 96. $1 of underlying per risk, maximum risk in this position. So you're taking the same risk initially, but you are dividing the thing into 2 units. Then, if the market moves lower, you obviously make money on both units. And you want to cover your risk, this initial risk here, with one of the units. So the distance from the short entry level to your stop needs to be the same as the distance from the short entry level to the first buy limit order, or the first profit target. Because when the market moves down here, you have made profits of $1 per the maximum risk, so $1 in the underlying, and then once you close one of those, you have banked 50 cents in the underlying, while you have 50 cents of risk outstanding or remaining. So if the market moves down here and then moves back to 96, you only pay the spread, or the spread and the swap, depending on whether you keep the trade overnight or not. If it's an intraday trade, then you just pay the trade fees in that spread, and that's it. That's your trading cost. Once this is taken, once the market has triggered this 94 level here, or the limit order here, then you have a risk-free trade, as much as any trade can be risk-free. Now we have the other unit. And therefore we need to give some room for the other unit to trade lower. So we placed the second limit buy, the take profit order, at $90. So it's basically, we are making 50 cents. Okay, let me talk about units here, just to make sure everybody understands how this works. The first unit is making $50, assuming the total risk is 100. Okay? And then that first unit is closed and we have the second unit left. Then the market moves from 95 to 90. So with that one unit, you make $250. Then you have $300 if the both targets are hit before the market moves to your stop order. And basically you have a reward to risk ratio of 3. 300 versus 100. Because that was your initial risk. Your initial risk was $100 here, and the market moved so much that you made 300. Now let's see how the market moved after this. And if you have any questions, if anything is kind of nagging you don't quite get the idea, you can either watch this video later on your own, and you can test this using a demo account, or you can ask your questions now. And let's see what happened afterwards. The two short entries happened here at 95. The market moved down to 94. One unit was covered there, and then the market rallied. It moved first, initially moved lower, then it rallied, but didn't quite hit the stop. This is where the stop for the second unit is now. After the first one is covered, the market rolls over and keeps on going and moves to $90. So that the benefits of this method are that you really don't, first of all, have to worry about the trade after the market has hit $94, right? But then you don't really have to do anything if the market moves back to your entry level, provided that your stop order at 96 isn't hit and the market just keeps on moving to your other target. So it's a perfect scenario for somebody who needs to work full time and he just happens to be available to see this signal here and take the trade, but then for the next 2 days really can't follow the market, and the market keeps on going. It rallies first but then keeps on going and makes a nice profit, and still the reward to risk ratio is 3-1. And I'm saying the risk in this trade is reduced to almost zero. I personally, when I talk with my trader friends, I talk about this as a risk-free trade. But now that we are here in the webinar, I need to be more specific. Basically saying that the remaining risks are there, and they are the spread that we paid, even though it's tiny with TO markets. Then the trade financing cost, if you're going to hold a trade overnight, there is a cost associated to holding the trade. And then the market gap risk, and this is mostly associated to weekends. So market might gap more if there is a big news event over the weekend. Say if a war starts, or if OPEC members comment something on oil, or if there is, say, for instance, some Fed talk, Fed bankers are saying something that nobody expected, then the market might gap. And then the market could gap beyond your stop order. So you really don't want that. The way to control that risk is to go and close your trades on Friday and reopen them on Monday. Then you are in charge. Then the market can't harm you by gapping beyond your stop levels. Obviously, there can be a market gap, especially in stocks during the week and during the trading hours. But that's very, very rare. If you go to January 2015, there was this huge event when the Swiss National Bank removed its euro peg from the Swissy. But that sort of event is very, very rare. Obviously, you have to take that into account, but it's not likely to happen every year or every 10 years or every 20 years. So this is way I look at the markets if I want to reduce the risks. If I'm very confident on my analysis, then I don't use these methods, and I just have a simple stop in place. But again, people have different tastes. They have different maturity levels in trading. They have different risk aversion levels. They function differently. So, guys, does this make sense to you? Again, let me know what you think. Alain is saying that with method 2, you don't have to worry about the market swinging back for a bit and then rolling over like in the other example. Exactly right, Alain. That is exactly, you got it. I can see that you've been trading for quite a while. This is what this strategy is so good for. So, I have covered what I had for today. We've spent here 3/4 of an hour. If you have any questions, now we can have some time for them. But we have covered what every trade entry strategy should include. You have learned also 2 methods for making trades risk-free to the maximum extent, to the extent that it is possible. And then you have also learned how to set targets. At least some aspects of this. There's so much more to learn, which you can obviously study on your own. You can realize a lot of stuff when you start looking at historical prices and you go and find situations where you could apply a strategy like this or method like this. I'm not seeing any questions coming in, but maybe I can ask you for a favor. I'd love to hear if this webinar was useful to you. So please give me a rating on 1 to 5 how good the webinar was, or how bad. Obviously that's fine too. So if it wasn't really good, if you didn't enjoy it, if you didn't find it helpful, give me 1. If it was just okay, give me 3. If it was excellent, give me 5. And please be very honest, because I value honest feedback, and that helps me to grow and think of how to basically improve my webinars and teaching to you guys. Okay, keep them coming. We have quite a few people here, and we have some points or some evaluations coming in. Thank you, guys. All right, Lati is saying he just applied this strategy in the markets. Excellent. Thank you. We have Tiziano giving me 5, Martha giving me 5, Lati giving me 5.1. That's not allowed, man. But thanks anyway. Yeah, it was good, says Peter. 4 score. And Lati is asking about gold market today. Basically, let me see. Have you seen my analysis today on gold? Yeah. Anyway, thanks. It's really humbling to see that you enjoyed this webinar, and I really hope that you choose TIO Markets as your broker, because we give you tight spreads, we give you a fast execution, very reliable customer service, so that you get your questions sorted and refunds sorted quickly. All of these jazz. So go to tiomarkets.com/register and open account as a big thank you for the great service that TIO Markets provides to you. Now, Lati was asking about gold. Let me see whether if I can bring up my analysis. If you haven't seen the TIO Markets analysis offering, go to tiomarkets.com/analysis, and once you register, you get access to this, and you get basically you get an email every morning where you have my analysis for the day. Often I look at what the likely price action is for the day or the next few days. So as you know, we have the biggest risk event of the week coming up. We have oil trading a little lower, so the headline CPI might be lower too. That's what the analysts are expecting. We have the core, actually the monthly core and headline numbers for the CPI are expected to come a little lower than the previous month. So that could be, if it happens, that could be dollar bearish. But if we get a very strong CIP reading, way more than anybody expected, then we should see dollar bulls taking control of the market and then moving gold lower. That's a likely reaction. It's not guaranteed. I should stress that it's really not guaranteed. And basically what I'm seeing in gold is that it rallied, it failed there to move into new highs. That basically tells you that the bulls were quite careful before the event. And now let me see where gold is trading at the moment. Here it is. So not that big, thank you. So gold is basically ranging here between roughly, if we look at this technically, we have this low here, which is my sort of key level. If this level doesn't hold, then maybe we move down further. If the level holds, or if buyers come in above the level, then we probably test the level up there. But see how often the levels, or the proximity of the levels that used to be important, are important again. And now the market moved slightly below, but then the move was rejected and the gold is moving higher again. So when you have an event like the CPI coming up today, we have lots of unknown variables. We have several unknown variables. First of all, we don't know what the CPI number is going to be like. Is it going to be less or more than the previous time? Roughly the same as the previous time? Is there going to be huge deviation from the previous number? Or is the number going to be very close to, is the deviation is it going to be small? And then also we don't know what the market reaction to all of these different events will be. We can estimate that, okay, if the CPI is really strong, then we can say that probably the Fed hawks will be even more hawkish, and the Fed will continue with aggressive rate hikes. That should drive the bond market down and the yields up, and that would support the dollar. If that's the case, then we just see that sort of manifesting in the price action. So really what you need to do is to map your key levels and then see how the gold trades around them and near to the levels. Yeah, so exactly, Lati is saying, so what you say is that it's wise to wait till the news are over. After the news, we know so much more. We know the exact numbers, we know the price reaction, because the price reaction is really the sort of opinion of the market. And the opinion of the market is the only one that matters. I often call market a Mrs. Market because, we as traders are quite married to this misses market often. And if we fight the misses, then our married life is going to be kind of awful. I mean, it's going to be very difficult very difficult life. So just when you are dealing with Mrs. Market, just learn to say yes, dear, and follow. That's your role. You don't be the one that walks first and tells your lady, follow me. With this the Mrs. Market, you are the one that says yes, dear, and you follow kindly and obediently. Because if the big money is moving money to a market to a certain direction, then you can't really turn the market. You just have to go with the flow. All right, guys, it's been lovely to spend time with you. Remember to stay obedient to Mrs. Market, and I look forward to seeing you in the next webinar. And if you would be so kind as to go and open a VIP Black account, that would be amazing. Go there, register your basically where you from. Say you're from Ethiopia, for instance, and then click here and you get the account. It's free. Then you can start testing with the demo account, and then hopefully you join us as a proper trader and put some money into your account. So, thank you. Trade safe, guys. I look forward to seeing you in the next webinar. And meanwhile, wait for an email from us, because you get a recording of this webinar. And if you like the recording, you can view it, share it. The more you do, the happier I am. Because I work hard for these and I would love to see a huge crowd. So if you can help me in that regard, I'm really blessed. Thank you, guys. Take care now. See you soon.